We have guest panelists today. We'll be speaking about insurance and condos, two really big topics that have hit mortgage, certainly the mortgage side. One of the challenges is we usually get insurance 2 to 3 weeks before closing. Sometimes we don't get the full condo approval until a few weeks before closing. We may find condominium associations out there that we don't see as an approved association. So there are a number of steps that loan officers have to go through. One thing that I like to do with my agents is to go out, search the county to see if there's lot and block, if there are any acres, and try to determine if it is a condo or a townhouse. I continue to be surprised at how many real estate agents and consumers will swear to me, Brian, this is a townhouse, and it looks like a townhouse, but it's a condo. So we worry about the legal of the property, and it may look like a townhouse, may be called a townhouse, but it probably isn't a townhouse. Just a couple more minutes and then we're going to get started. We ask everyone to mute if they could. We appreciate that. And again, we appreciate the time you've taken to join us today. We will have follow-up. So I hope to be recording this once we get started. And I can send that out to those of you who would like it. And we can also send out the presentation so you can keep that as reference. Just another minute or so and we'll get started. Forrest, Laura made a good suggestion. I think when we're not speaking, we'll just put ourselves on mute as well.
Sounds like a plan.
Well, without further ado, I am going to get started. It sounds like Gail Flom is having issues. Jordan, could you possibly communicate with her? See if you can help Gail Flom out. Without any further ado, I'm going to get started. I'm Brian Parkinson. I'm the host today. We've brought in some expert panelists today to hit some very hot topics. That's home insurance and everything that goes on behind the scenes with home insurance and all the changes nationally. And also Oris Tomaselli, our East Coast New Yorker from Long Island. And I gave him a little bit of a hard time earlier because he doesn't sound like he's a New Yorker. So maybe he can bring some of that out for us today. For some of the housekeeping, we ask you to keep your phones on mute. We will, if you have questions, please go into the chat box, post your question. My assistant Max will gather those, and at the end, we will try to go through as many questions and get to those as possible. I'd like to tell you a little bit about Alaris Mortgage. So we started as Residential Mortgage Group January of 1995. We went through the financial crisis, and in 2010, Alaris Financial, a bank out of Grand Forks, North Dakota, purchased us. We were introduced to them through the feds. It ended up being an excellent marriage because mortgage companies that are tied to banks bring a lot of additional products. We lend in Minnesota. Our corporate headquarters are in North Dakota, although all of our C-suite members are in Minnetonka. We recently acquired Home Federal Savings out of Rochester, and that's expanded us into Iowa and also Wisconsin. I think in the future, we'll probably be considering opening up lending in Colorado. But Alaris, as a federally chartered bank, we lend in all states but Alaska and Hawaii. So you want to keep that in mind. We are a $5.32 billion financial institution as of June of this year. And most of you that are working with us know that we have a $20,000 guarantee. We were the first company in the Twin Cities to start this years ago. And it's all about the client's experience, our connection, and support for our real estate partners who are our true clients, with the intent that you can always count on closing with us because we're going to guarantee the approval. Now, if we have appraisal issues or if we have title issues, that's separate from the borrower's credit. But that's a very important part of our business and has helped many of our clients win offers. We have portfolio lending. Kelly Rumjeski's with us today. She's the head of our underwriting department. And we can offer doctor loans, professional loans, borrowers who are out of the box. We've also newly acquired some new investors that offer loans on asset lending for those that have no income that have significant assets. So we have some ways that we can make that work as well. Don't forget, we do construction loans. I would say the average tenure of a loan officer at Alerus is probably 20 to 30 plus years. We've got a lot of experience and our back room is second to none. Our first speaker today is Laura O'Neill. So I'm going to read a little bit about her. She's with Cornerstone Insurance. I met her through a client. So our borrowers go out and get their own insurance. Laura was recommended to us. We loved her premiums, but more importantly, her communication, her timeliness, and she really stood out. She was a real estate broker for 10 years. She was a loan officer for 1 year, and she's been co-owner of Cornerstone for 24 years. She has a foundation serving the inner city called the Fan Club Foundation that serves young teenage boys in North Minneapolis, which is just incredible. So Laura will be our first speaker. Following Laura, we have Orest Tomaselli, our East Coast New Yorker. Orest works in association management companies throughout the U.S. He's an expert in the shifting condominium landscape, offering clear insights. He also partners with Community Association Institute, contributing his policy expertise on lending requirements and reserve study standards for condos. He is the expert nationally. I think he also works with some associations within the Twin Cities. He serves as CAI's Federal Legislative Action Committee and Reserve Study Best Practices Task Force. Alerus is very happy to share. We have built a relationship with Condo, which he's a partner with, and they are helping us with all of our back-end condo approvals, and we're so happy to have him today. Last but not least is Kelly Rumjeski. Kelly is our Director of Consumer Credit. She's been in the underwriting business for about 25 years. She comes from a family history of underwriting. She is our go-to. What I love about Kelly is she has the mind and approach of an originator. If it's a weekend and we have a very tricky file, Kelly is known to pick up the phone with a loan officer and talk them through it. Very few companies out there do that. We're happy to have you here. I am going to start recording once Laura begins. We'll send that out to those who like it. If you're not associated with Alerus, send me an email, brian@brianparkinson.com, and we can get you connected with an Alerus loan officer. I'm going to turn it over to Laura, and thanks so much for joining us.
Thanks so much, Brian. I really appreciate it. I am so excited to be here. My name is Laura O'Neill. I'm out in Victoria, Minnesota, which is like a western suburb of the Twin Cities, if you're not familiar. And like Brian said, I've been selling insurance for about 25 years. I like to refer to myself as the insurance nerd because I'm really geeky about insurance. And I think you'll see today why. Minnesota, as you probably know, is going through some pretty hard times in insurance right now, which is affecting the real estate industry. So the reason I'm here today is I just kind of want to go through what market conditions are so that you are more educated and informed when you're representing your clients. And hopefully that helps distinguish you from your competitors and also protect your buyers or sellers as much as you can. So basically today I'm going to talk about a couple of things here. The first part of what my talk is going to be about is the single family homes. In insurance world, we call those HO3s. Single family and duplexes are all written on a policy called an HO3 or homeowners insurance policy. The second half of what I'm going to talk about today is condos and townhouses, which is going to lead into what Orist is going to talk about. I'm going to show you the consumer perspective, and then Orist will talk to you about the lender's perspective and how those fit together. The reason why I think this is such an important topic and why I'm so passionate about it is that what I see on my end, which is kind of the end of the circle. The circle starts with hopefully a pre-approval, right, Brian? And then a realtor, and then looking at houses, and then they start the loan process before they get to closing. A lot of times the last thing that home buyers consider is home insurance. A lot of first-time home buyers don't even know they have to buy homeowners insurance. And then they find out 2 weeks before closing that they need to buy this policy. And unfortunately, because of the changes that are happening in Minnesota with homeowners insurance in particular, I've seen a lot of deals blow up at the 11th hour because of the nasty homeowners insurance marketplace. So I want to prepare you for that as much as possible. So let's just jump right into that. Um, the whys is always important to me as an insurance nerd. I like to know stuff. So the biggest reason that homeowners insurance is such a nightmare in Minnesota right now for single family homes, but also for condos, is because of my favorite four-letter word, which is hail. Um, when I started in this industry 25 years ago, the typical Twin Cities house, single family house, $400,000 house was $800 a year for insurance. 5 years ago, it was $1,500 to $2,000 a year. Now it's $3,000, $5,000, $6,000 a year for homeowners insurance. And that's for a house with a new roof, with good credit, and that's a more modern home. Any kind of problems like claims history, mediocre credit scores, and all of a sudden those premiums are 6, 7, 8 grand for home insurance. So that's important to know. Um, the reason why we got into this situation as an industry, as an insurance industry, is that policy coverages were way too broad. They were paying for everything under the sun. And that really started to affect the profitability of insurance companies, which resulted in these major changes that we're going to talk about next. So the big thing that you probably have heard, if you haven't heard it yet, you're going to hear it sooner or later, is that roof is the most important thing for homeowners insurance. Every insurance agency company agent out there is going to, the first question they're going to ask a homeowner after they find out the address is, how old is the roof? Over on the right-hand side of the screen, you can see some examples of what I'm talking about here. Most insurance companies have restrictions on what age of roofs they will accept on a single-family home. A lot of them are also, in addition to that, have conditions on what coverages they will offer. So, for example, I would say like the one right in the middle, that American Family example, is pretty common in Minnesota right now. So they'll only accept a 10-year or newer roof, and they want to depreciate the coverage. So let's talk about depreciated value, because this is the one thing that's really upsetting lenders. In some carriers call it ACV, that stands for actual cash value. Some carriers call it depreciated value. Some carriers call it roof payment schedule. It's all the same thing. We like to use a lot of different words for the same thing in the insurance business. ACV is how I'll refer to it for our sake. So basically what they're saying is, hey, we can't afford to keep buying people brand new roofs every time that we get hail in the Twin Cities. So what we're going to do is we're going to depreciate the roof, kind of like how cars are covered by insurance. If you total out a 10-year-old car, you don't get a brand new car. Everybody's comfortable and accepts that. On home insurance, the story has always been, if you total out a 10-year-old roof, you get a brand new roof. And insurance is not intended to make consumers better off than they were prior to the storm. But it's a hard thing to negotiate, because you can't just go buy a 10-year-old roof and slap it on your house, right? So insurance companies are very particular in the wording of their language and their policies to explain and also enforce these changes. So here's an example down at the bottom here. Typical suburban house, $40,000 to replace. Let's say the roof is 15 years old. Somehow it's currently insured. The replacement cost of that roof is $40,000. That's 3 years ago, that's what the insurance company would have paid if it had hail damage. Now what they're paying is the depreciated value. So if it's 15 years old, let's say it's worth 25 grand, the claim payment might be $15,000 if the insurance company depreciates the labor as well. This is an example right here of one of the insurance company's actual policy language. I can't tell you who it is because this is top secret information. No, I'm just kidding. It's not. Roof surface material payment schedule is what this is called. It's the same thing as ACV. And if you look, there's a couple of different columns here. I get the question a lot from consumers. My roofer's trying to convince me to buy class 3 or class 4 shingles. Does that make a difference in my rates? Because the roofer tells the homeowner that it does. The answer is not really, but what it does make a difference on is how much you get paid when it gets depreciated. So if the first column shows class 3 or 4 impact resistant shingles, also known as like architectural shingles, if you look at a 15-year-old roof there, that's saying that the customer is going to get 55% of whatever the replacement cost of that roof is. So if you go back to that example of $40,000, they'd get 55% of that. And stapled to that check, I like to say, is a little letter that says, by the way, here's your check for 55%. You've got 30 days to put a brand new roof on your house or we're going to cancel your insurance, which is crazy. Insurance companies are very, very strict. I always say, think of it like your old grandpa, who also is a lawyer. That's how insurance companies act. And so they're very matter of fact. They follow their contracts. Insurance policies are contract laws. They don't negotiate on this stuff. They're very, very strict. And because they've lost money for the last 5 years in a row, they're enforcing this now more than ever. If you move to that second column, you see how it says all other composition shingles. That's most shingles that were built prior to 2005. So you can see the difference in how much you're going to get paid out if it's a 15-year asphalt or architectural shingle versus a 15-year regular asphalt composition shingle. One thing that gets brought up a lot is wood shingles. If you sell a house with wood shingles, please have your buyer call their insurance agent before you write that offer to see if they even have the ability to write wood shingles. I'm an independent insurance agent. I represent 14 different insurance companies, 14 of the best ones in Minnesota. And I only have one carrier out of those 14 that'll take a wood roof. So be really, really careful when you're selling houses with wood roofs. They look beautiful. Unfortunately, insurance companies hate them because wood roofs need maintenance, as you probably know, you're realtors. But the insurance company has no way of telling if the homeowner maintained that roof or not. And so the other problem they have with wood roofs is that they cost 4 or 5 times as much money to replace as a class 3 or 4 impact shingle. Metal shingles are the solution. That's what, as you can see by those percentages, if you look at the 15-year mark, 70% is what they're going to pay out at 15 years. They go down to 50% at 25 years. They love metal roofs. If you can encourage a buyer or if you work with home builders, encourage metal roofs, that's the future of the business. That's what insurance companies prefer. And they really love to have those metal roofs. So if you're talking to a buyer and you're saying, hey, you know what, this roof has a 30-year-old, this house has a 30-year-old roof on it, I think you should plan on replacing this roof immediately. You might want to look into the cost difference in metal roofs. That's a preferred material for roofs. So that's HO3s and homeowners, single families. Fun stuff. I'm going to spend a little bit of time now talking about condos and townhouses. The insurance industry, we're weirdos. We think that condos and townhouses are the exact same thing. As far as insurance is concerned, they are. Realtors, lenders, consumers know there's a difference. The picture that I'm showing here is a townhouse. Usually like the buildings that have little apartments in them are condos. It doesn't make any difference in insurance. So we don't care what it actually is. All we care about is that there's an association that buys a master insurance policy. Those are the big things. There's been, because of hail and what's happening in the homeowners market, That's also trickled down now to condos and townhouses. Um, for those of you that aren't really familiar with master association policies, I put this together just to give you a quick little insight into what I'm talking about. Master policies are what the association buys to protect the community. There's basically three types. In insurance, we say there's three types. There's the all-in policy, which is the best. The original specs, you've probably heard that term before. That's original specifications. It's decent coverage. And then there's the bad one, which is bare walls. Unfortunately, because of the marketplace, a lot of associations are either knowingly or unknowingly, because the rising cost of master policies, they're choosing this bare walls policy, which is a significant difference in coverage. The other thing that's happening in master policies, excuse me, there used to be $1,000 deductible on these policies because everybody's making money, everybody's happy, and insurance, the rates are low. As the insurance companies started to raise the rates, these master policy deductibles went up, just like car and home insurance deductibles went up on your own personal insurance. Except for they didn't just go up a little bit. First, they went from $1,000 to $5,000 maybe 10 years ago. Now all of a sudden we're seeing $100,000 deductibles per unit, or 5% wind and hail deductibles on these master policies. And Orest is going to get into a little bit of why that's a problem. But what I want to talk to you about is what you can do for your customers to prepare them for this conversation that they're inevitably going to have with their insurance agent once they get to their insurance agent store. So let's just talk about the difference between the master policies first, like which type they bought, the association bought. So the first one is if it's an all-in policy, that's the good one, right? Let's say it's a $400,000 townhouse. The insured is only going to have to buy $80,000 of coverage A, and the only reason they have to buy $80,000 even is because the lender forces them to buy 20% of market value, right? But really, in real life, they actually need zero in coverage A right here. The cost of that policy is going to cost the consumer about $400 a year, 300 to 450, somewhere around there. Let's just say 400. If the association bought the bad policy, which is called the bare walls policy, that means that they have to cover the entire interior of the unit. So if you think about a typical $400,000 townhouse with 3 baths, 1 kitchen, that kind of thing, they're going to need about $200,000 of coverage on their HO6 policy. And the cost of that is going to be about $1,300 a year. The reason why that matters is obviously that's going to affect the qualifying ratios for the buyer, right? That's another $75 a month into their ratios. Same problem you have with homeowners HO3s, you're going to start having with condos because they have to buy these big policies. The other part, which is what my last paragraph is about, is this deductible change. There's 2 huge problems there. The biggest problem that we're facing, even as an independent agent, is that some of our companies say, you know what, we don't want to buy that burning layer of coverage. What I mean by that is insurance companies know, because all insurance is statistics, they know that more than likely, if an association buys a big, huge 5% deductible wind and hail claim policy, the burning layer, the most likely claim that's going to happen is wind and hail. And more than likely, it's going to fall under the association's deductible, which means that the townhouse owner is going to have to pay 100% of that roof replacement. Okay. An example, I own a townhouse that my mom lives in. It's side by side. So I own one side, the neighbor owns the other. Our association decided to turn in a hail claim. The hail claim ended up being roof replacements, approximately $18,000 per unit. Now, normally, back in the good old days, the master policy would pay for that. And each homeowner might get assessed $1,000 deductible. This time around, every single unit had to pay $18,000 towards the deductible, but really they're paying for the roofs. So what the associations are doing by buying these high deductible policies is they're essentially passing that burning layer, which is an insurance phrase that we talk about a lot. It's where's the burden? The burden of claims is getting passed on to the consumer. So from an insurance industry perspective, what that's doing is it's essentially churning a condo policy into a homeowner's policy because we're going to have to pay just as much claim as we would have had to pay if it was a single family home. And so as a result of that, insurance companies are doing one of two things. They're saying, let's double the rates. So rates for condo HO6 policies are way higher than they've ever been before. And they're saying, which is what I'm talking about at the bottom here, we're only going to give you $10,000 of coverage. Tough luck if your deductible is 50 grand. If that happens to your buyer, the buyer has to move their insurance to another carrier, which could end up costing them more for everything. They could pay more for car insurance, that kind of thing. So it's kind of a problem that we're seeing a lot on condos. My indication is it's only going to get worse. Everything that I'm hearing within the industry from the carriers and the leadership is they've had it with HO6 and how those policies are responding to claims. They're sick and tired of these master policies passing the burden on to the HO6. And so now most of them are choosing one of two paths. They're either doubling rates, tripling rates, that kind of thing, or they're saying we're not going to sell this anymore, which is way worse. So good times. This is an example that I put together just so that you guys can kind of understand what the difference is. So this is an example just like the building I was talking about. Let's pretend it's 2 units, two side-by-side beautiful townhouses on a golf course. $60,000 to replace that roof. The deductible on the master policy is 5%. So let's say that the building, 1.2 million is 60,000 per building. You take that building, you divide it into 2 units. So each unit has to pay $30,000. If the homeowner does not have the right loss assessment coverage on their HO6, which is the condo owner's policy that we sell them as insurance agents, they're going to have to come out of pocket for that money. That's a huge exposure for buyers of townhouses and condos. This is all bad news. Insurance agents are known to be doomsdayers. That's kind of our thing. But I really feel like there's a really big opportunity for realtors out there, especially right now. If you're informed and you know what you're talking about, and especially when you're working with young buyers, or even a traditional buyer who's moving out of a single family home and buying their townhouse for the first time, and they don't really understand how this all works. Understanding this, I think, really sets you apart from your competition. From what I've seen out there, just from my perspective with lenders and realtors, is that having this knowledge, you're protecting your clients better, you're selling them better houses, you're doing a better job by them, and you're also getting their respect. So my tips are always find out the age of the roof when you're selling a single family house, for sure, every single time. One of the tricks that I use, I actually have this ongoing spreadsheet, Excel sheet that I created myself. And whenever I have to go look up a town, like let's say I'm selling a house in Prior Lake, I figure out whether or not they've got building permits online, and then I just keep a spreadsheet of every little city in Minnesota. I'm happy to share that with you guys if you want to see it. Just email me and I'll send it to you. It's a scratch little version of it, but the other thing is negotiate for buyers ahead of time. So one of the things that I've seen that has helped realtors be successful when you're selling a house that has an older roof is anticipate that their insurance agent is going to say, no way, I can't insure this house because it's a 20-year-old roof, for example. Know that before you write the offer and then negotiate it into the offer. Because I can write a consumer who's buying a house with a 25-year-old roof as long as of closing date, they have a signed paid contract to a roofer to replace it in the next 30 days. So, work that into your offers a little bit. Negotiate compensation so the buyers can do it themselves, even if it's old, even if they can get insurance. It's a big deal. And insurance companies in general in Minnesota are really cracking down on this. So set them up for success. For condos and townhouses, my best advice is to review the master policy before you write the offer. You need to know if it's an all-in or if it's a bare walls policy. You need to know if the deductible is $10,000 or $100,000, because then you can anticipate what your buyer's going to pay for HO6 insurance, and you can factor that into your offer. The other problem that I'm seeing, and this just isn't a plug for myself, it's for the entire industry, is that we're living in a world where everybody buys everything online, and I'm sure you experience this as real estate professionals all the time too. It's really important to buy your homeowner's insurance or your condo insurance from an actual human being instead of the internet, because there's so much that goes into the quote, and that all this investigation and then setting up coverages, removing what we call exclusions on policies, things like that, that computers can't do for you yet. I'm sure they're building an AI as we speak that will be able to tomorrow, but today you need to talk to a licensed agent who actually knows what they're talking about. Tell your buyers to do that. It's all the same price as buying it online anyway, so why not use a real agent? That's all I've got for you guys. I hope I really made your day with all this fun information, but feel free to reach out to me anytime. There's my contact info. I'm sure Brian's got it on the Zoom too, so that's all I've got for you.
Excellent stuff, Laura. Thanks so much. One thing I would point out as a homeowner, we got notice at our most recent renewal that our insurance provider was dropping replacement of our 9-year-old roof to, gosh, 75%. With that, I also found out that there were a couple companies out there that this is their process now. They're big national companies. Going to Laura as a small independent broker with her ability to shop multiple different investors for insurance made the difference, and it held our premium as it was actually going to go up about 40%. So next, I'd like to turn this over to Orist. Thanks so much, Laura. That was great information, and we'll turn it over to Orist.
I have to start by saying, Laura's kind of my insurance spirit animal. Like I listened to her last time and I met her a couple weeks ago and had a conversation, and I was just totally smitten with her knowledge on insurance. So that was great. In fact, I'm gonna have a conversation about something you said in just a minute. So thank you guys for having me here today. I have a really interesting presentation for you. I'm going to teach you today a little bit about what's going on with residential mortgage financing in condo properties, how Fannie Mae and Freddie Mac have impacted residential lending, who they are, and why it's become more difficult to get residential mortgage financing for condominium purchasers and owners. So let me jump into this very quickly so I can kind of take you guys down the road. So Brian gave me essentially read my bio. What's interesting about my bio is that I am currently in the process of working with CAI and their Government Affairs and Federal Legislative Action Committee, as well as their Reserve Study Best Practices Task Force, in order to kind of look at what's going on in the industry and kind of provide solutions from all the stakeholders, whether those are large insurance carriers or lenders or whomever is impacted by these lending guidelines, directly to the agencies. So it's a really interesting role. And it's been a very successful insofar as that I've really been able to have an impact on what's going on with condominium lending and how lenders look at lending into condominium communities over the last couple of years. On average, our webinars that we provide at Condo Tech have about 4,000 to 5,000 attendees. And those are primarily lenders and property managers throughout the industry. So I'm so happy today to present this information to the real estate community, because you're really the front lines of what's going on with condominium lending, or how you're going to be impacted greatly by this. So the first thing I thought was really important, and yes, Brian, I don't know, my daughter thinks I have a New York accent. Maybe that's only when I get angry. But with my non-New York accent, I want to tell you who Fannie Mae and Freddie Mac are, right? The agencies are incredibly impactful across the United States. They are government-sponsored entities. They buy and guarantee mortgages from investors in the secondary market and lenders, and they are responsible for more than 50%, approximately more than 50% of all loans originated in the United States. What's interesting about that statistic is that even though they're responsible for 50% of the loans in the United States, the guidelines issued by Fannie Mae and Freddie Mac are utilized by most of, if not all of, the secondary market for lending that exists. And that's portfolio lending, non-warrantable lending. Essentially, everybody goes back to Fannie Mae and Freddie Mac guidelines and when they're lending into condominium properties and almost any property. And these secondary market investors say, well, does it differ from Fannie Mae's guidelines? Why is this building non-compliant? Why is it compliant? Why is this property, why should we lend into this property? And that's all based upon Fannie Mae and Freddie Mac's lending guidelines. So these GSEs, government-sponsored entities, Fannie and Freddie, have very specific and prescriptive regulations for lending in condo properties specifically that mortgage lenders have to follow in order for those loans to be eligible for sale to the agencies or to be guaranteed. So when a lender, ABC lender, provides a mortgage to any borrower who is purchasing a unit in a condo property, they're going to Fannie Mae and Freddie Mac's lending guidelines often first and seeing if that borrower and or that property complies with these agency lending guidelines. It's often a lender's first stop because Fannie Mae and Freddie Mac interest rates are the best in the industry often. So it's the path of least resistance, or it has been for many years up until kind of the last 18 months, and we're going to talk about that. The differences between the two agencies, the lending guidelines are very similar. There might be a couple of little differences about how they look at insurance in some ways, or how they look at, different aspects of condominium properties. But the agencies are essentially aligned in their lending guidelines. So how have things changed? Well, there is this heightened focus on condo units and the health and safety of the condominium properties, as and there's been a change into how the agencies look at reserve studies and the financial health of communities and the future repair and replacement of components in these condominium communities, how much capital they have sitting in their reserve account, how they're funding their reserves, if they have any reserves whatsoever. And that's all super impactful on whether or not a purchaser can get a mortgage in one of these properties. What has happened, and the reason the guidelines have changed so drastically, it's all primarily as a result of the tragic collapse of the Champlain Tower condominium property in Surfside, Florida, about 5 or 6 years ago. That tragic collapse, and there was a tremendous loss of life when that tower collapsed, really changed how not only Fannie Mae and Freddie Mac look at condominium lending, but it also changed how insurers look at insuring these condominium properties. It has gotten to such a point where the agencies have created something called an unavailable for lending designation. And that unavailable for lending designation, if a condominium property is listed as unavailable for lending by Fannie Mae, that means that residential mortgage financing is virtually impossible to get in that property through Fannie Mae and Freddie Mac. And the only type of mortgage financing that's available in that property is non-warrantable lending or portfolio lending, which often comes at much higher interest rates. So it's incredibly important for condominiums to comply with Fannie Mae and Freddie Mac lending guidelines, because this unavailable for lending designation doesn't just mean that condo lending is hard in these condo communities. It also means that unit value typically drops substantially in these communities. So as an example, if you are going to buy in a unit in a condominium property that has this unavailable for lending designation because that property doesn't comply with Fannie Mae or Freddie Mac's lending guidelines, it means that you'll have to put down a significant amount of a down payment. A 3% or 5% or even a 10% down payment is really not tenable. You can't get that type of mortgage financing, or it's very difficult to get, and purchasers are going to pay very high interest rates, and it's really going to be difficult to get a refinance on any of those properties within those unavailable communities as well. So unit values, we've seen across the country, dependent upon the geographic area. We just have updated numbers on this. Anywhere from 15 to 40% drops in unit value, depending upon where that property is geographically, is what the industry is seeing if an unavailable for lending designation is on a condo property. That's gigantic numbers, okay? Gigantic value reductions if you're not compliant. So that being said, I just wanted to kind of give you the overview of why Fannie Mae and Freddie Mac were so important. But let's jump into some data on ineligibility. So why are these condominium properties ineligible for residential mortgage financing? Well, at Condo Tech, we do between 1,500 and 2,500 individual condominium property reviews per month. So we have arguably more data on this than anybody else in the industry, perhaps not more than Fannie Mae or Freddie Mac, but any other public company or private company out there, we have more data about why these properties aren't compliant than anyone out there. So when we do a review at Condo Tech, and that's one of the services we offer, we either offer that service directly to lenders. We have about 800 plus lenders that utilize us for these condo reviews or data sets on condominium properties, or directly to condominium associations that are looking to find out if they're eligible for residential mortgage financing. We have a product that we call Lending Compliance Report that we offer to those communities and tell them if they're compliant with Fannie Mae and Freddie Mac guidelines, if they're not, and how to essentially get compliant with those guidelines. But this is the data which we found. Initially, it's important to note that about 46% of the condo properties that we review monthly are initially ineligible for residential mortgage financing. That's a gigantic number as well. That number has leapt up from, on average, 10 to 15% of the reviews that we performed in the past. So you're looking at a giant surge in ineligibility. And why is that? It's because insurance guidelines have changed, reserve guidelines have changed, deferred maintenance, critical repairs guidelines have changed, fidelity insurance guidelines have changed, and special assessments are now prevalent, and special assessments in condominium communities that aren't compliant are prevalent out there. So where I'm going to really align with Laura on this is that earlier, and the number one reason, about 35.9% of the projects we reviewed out of this, and by the way, this is only a sampling of 1,000 condominium properties that we reviewed, I think July or August of this year, or June, data provided as of June. So this is 1,000 properties that I pulled and saw why they weren't compliant. 35.9% of those properties were non-compliant because of association insurance. Master insurance policies not being compliant. 22% of those properties were non-compliant because of their budgets, their condo budgets, or they didn't have the appropriate amount of reserves, or they weren't collecting the appropriate amount of reserves every year in their operating budgets. 16% of those properties were non-compliant as a result of deferred maintenance or critical repairs, part of the common area components in the property, whether it was the roof or the exterior or maybe a roadway. So there was some sort of critical repair that had to be performed to one of those components, or mechanical components, a boiler or an HVAC system wasn't functioning, and that repair was not complete at the point in time of our review. Fidelity insurance, which is insurance, is also called employee dishonesty insurance, essentially, that condominium associations are forced to carry. There's a calculation that ties into how much reserves a community has, and what their maintenance payments are. And fidelity insurance, although this is an easily fixable kind of issue, it's responsible for 13% of the properties not being compliant. And then special assessments, a lot of condominium communities across the country operate via special assessment, meaning when something breaks, they take up a collection to collect the cash to do the repair. The agencies do not want communities to operate via special assessment. They want them to save money in a reserve account for a rainy day, for when components actually do fail. Most special assessments are compliant, some are not. It's not that the agencies don't allow special assessments, but they don't allow special assessments when they're for repair or replacement of components that are going to impact the health and safety of the unit owners. And special assessments have to be paid in full, and the work to the property has to be performed in order for these properties to become compliant again. So these are the main issues as to why condominium properties are ineligible for residential mortgage financing. So let's delve into one of them. Master insurance policies. I could not do the type of job that Laura just did in explaining insurance, because I thought that was spectacular. But coverage levels are incredibly important. A lot of communities that we see out there don't have enough coverage, and that is as a result of values of condominium properties going up. So when you're looking at providing a master insurance policy to a condominium property, you're insuring the entire property, right? So every increase in value to a unit increases the total value of the community. And we're finding that a lot of communities don't have the appropriate coverage. Some states require that you do an appraisal of the entire property every so many years, and that's a great way to determine what the appropriate coverage is. But a lot of insurance carriers have internal software that makes this determination. We're finding that coverage levels just aren't high enough for these communities, because they're basing it on data that's old. So that's one of the things that we typically see in a community that doesn't line up and makes it not compliant. As Laura outlined earlier, the perils have to be listed and covered within these master insurance policies: fire, windstorms, water damage, and other common risks to ensure broad protection for the property. Hail is a big one, right? And if they're not listed there, essentially, if they're not covered, the properties aren't compliant. In addition to that, there has been this massive change in the industry with a maximum deductible that Fannie Mae and Freddie Mac will accept for master insurance policies, and that deductible is 5%. So let's delve into that for a second, because that's a big one. We have seen a lot of communities across the country, condo communities, have deductibles that are much higher than 5%. We're seeing, 10% deductibles, double the amount for the deductible for the accepted coverage. What's interesting about that is why, right? So what's happened is insurance costs have surged, right? And condominium boards and management want to keep costs as low as possible. They don't want to increase maintenance costs by increasing the cost of an insurance policy. So they do everything they can in order to keep those costs down. And one of the ways to keep an insurance policy cost down is to increase the deductible. So if there is some sort of catastrophic event that the homeowners are responsible for, 5% of that. Essentially, that's what Fannie Mae wants to see. But if you increase that to say, oh, the homeowners are going to be responsible for more, then the cost of the insurance policy goes down. So that is totally unacceptable. The maximum deductible is 5%, and the agencies are dictating that 5% number. The replacement cost basis is now required. One of the things, and actual cash value, which is something that Laura brought up earlier, is no longer allowed. So she gave an amazing explanation of this, right? One of the things that I noticed when Laura was talking was that she was saying how much a unit owner or an owner of a property was going to have to pay if they had to replace that roof. And the roof was a really good example. What the agencies have outlined is that they don't want a financial impact for the community and therefore the residential unit owners in condo properties. So they are not allowing actual cash value insurance for roofs. They want to make sure that there's a guaranteed replacement cost coverage. So in the event of a loss, in the event that a condominium property has to replace the roof on their property, okay, that they're not going to be taxed or charged for the replacement of that roof because it could cause financial insecurity and difficulty for them, those residential unit owners, in paying their mortgage, right? That's essentially the thought process behind it. And this is a big one across the industry because, carriers and, have been offering this ACV policy, actual cash value, and it's totally unacceptable right now. That being said, let's delve into some of the other things. Litigation. One of the reasons for ineligibility is, litigation on a property when, condominium association is being sued. Well, that is impactful, and you typically find that out when you're asking questions, prior to signing a contract to sale on a unit in a community. But you want to find out if there is litigation on the property. It could cause financial instability. It could cause, possible future special assessments, especially if it's construction defect litigation that a condominium association is filing. If there are really construction defects in a new construction condo property or a recently built condo property, we're seeing kind of a surge of construction defect litigation. And it essentially renders these condominium communities ineligible for residential mortgage financing and lending unavailable. But litigation is really any suit filed against the association, and not all suits are non-compliant. There's plenty of slip and fall cases. There's plenty of lawsuits against an association that the insurance company is going to cover. And as long as you can prove that, along with an attorney letter, you could still get mortgage financing in the community. But if it's impactful, if the litigation is impactful to the health and safety of the residential unit owners, like let's say they're suing for, a massive structural issue on the property or crack down the outside wall of a property that could impact the health and safety of the residential unit owners, then that property is going to be ineligible for residential mortgage financing until that work is performed and the litigation is resolved, because it's a financial issue for the association and it's also a health and safety issue for the association. What I wanted to outline here, and just take a little break here to kind of tell you what we do. So we offer lenders our Condo Pack product at Condo Tech, where we provide them with all the data they need to review condominium properties directly. We also provide them with a condo project warrant product, where not only do we provide them with all the appropriate data on a condo community, but we review that property for them and we warrant it for eligibility with agency lending guidelines. But the thing I wanted to focus on here is this lending compliance report. I don't often try and sell products during a webinar, but it's really funny when I'm talking to realtors and property managers. One of the only ways to get this data right now, if there was a competing product, I'd tell you about it. But we offer this lending compliance report to condominium communities, and typically boards hire us. But sometimes, and of late, we've had realtors hire us to do a compliance report for a community to see if it's compliant with residential lending guidelines prior to having a purchaser execute a contract or prior to putting a listing on the market. And it's been a spectacular product for the industry, and it's something that, it's easy to order online, but I thought I would make it known that that's one of the products that we do provide as a resource. Again, I hate selling, so I'm not trying to. I just want to let you know that there's a resource out there that'll let you know whether or not a condominium property is compliant or not. One of the other issues that we bring up regularly, or we see regularly, is deferred maintenance and critical repairs. So I've kind of been talking around this issue. What the agencies really want to make sure of is that there are no health and safety impacts to the residential unit owners in a condominium property. And this is one of the main reasons why condominium properties are ineligible for residential mortgage financing. Structural repairs that are incomplete, component repairs that aren't complete. I saw a condominium community that had two HVAC systems and one was shut down, totally broken. And I talked to the board and the property manager. I said, well, you got to complete the work to this. You got to fix this unit. It's like, well, it's about $40,000 or $50,000 to do the work to this HVAC system and get it working again. And we have a second system that covers about 40% of the property, and the board thought that's kind of enough. Well, that's an issue, right? The agencies, Fannie Mae and Freddie Mac, are not going to lend into a property like that. So the work for critical repairs or deferred maintenance has to be performed before residential mortgage financing is available in these communities. What the agencies are looking for is financial instability. They want to make sure that the association, again, has enough reserves to do these critical repairs, that these critical repairs and deferred maintenance is complete, and that there are no residential or health and safety impacts to the residential unit owners. The bottom line is this: condominium properties that have substantial structural, mechanical repairs that need to be performed are less valuable. And now, with this added pressure of not being able to get mortgage financing in these communities, they're really less valuable, as I outlined earlier. Special assessments, I kind of went through this. The reason why the agencies and lenders have a problem with some special assessments is that they could cause financial instability for the residential unit owners. It could be a possible financial strain for residential unit owners if a condominium is operating that way. It often is a red flag or an indicator of inadequate reserves in a condominium community. It's often an indicator that there's critical repairs there, right? It's how we find critical repairs. And again, these typically negatively impact unit value. You don't want to buy a unit in a condominium property that has a special assessment of, $2,000 a year on it, or $10,000 a year, or $20,000 a year on it, that the unit owner is going to have to or the new purchaser is going to have to take over. So really impactful. Fidelity insurance, I outlined this earlier. It really revolves around, ensuring that the association is safeguarded financially. And there are very specific financial controls that are required for fidelity insurance, and the agencies have been really looking deeply into the compliance around fidelity insurance. We review it in every single instance, and the fidelity insurance has to cover all the reserve funds. So a good example of a non-compliant building is if they don't have enough fidelity insurance, if a community started to reserve appropriately, and now they have, instead of $200,000 in a reserve account, they have $800,000 in a reserve account. Well, the fidelity insurance, that was obtained prior to those reserves being in the account, may not have been enough, and they would have to increase their fidelity insurance. This I call one of the easiest problems to fix in the condominium lending arena, because fidelity insurance costs aren't that substantial. So often we see, increases, cost an association $200 or $300 or $500 a year. And it's not really impactful. Whereas a change to reducing a 10% deductible to a 5% deductible on a master insurance policy could be really expensive. That being said, I am here to provide answers to any questions you have. Hopefully I can answer them. I usually am able to answer them. We put out a lot of data into the industry, a lot of webinars, a lot of resources to our lender clients and our condominium management clients, and to realtors across the United States. We're probably one of the best resources for determining lending compliance in the community. So if you have a question, please email me. Try to get back to you quickly. Usually I try to respond in 24 hours. And I'm happy to answer any questions we have here today.
Boris, excellent information. Thanks so much. We're going to compile questions and come to that. But before we do that, I just want to cover one thing that's very interesting on condos. Sometimes if a building isn't Fannie Mae approved, we will get calls in, since we are a portfolio lender, asking if we'll finance that property. We obviously get Kelly involved in that. Just because someone's putting down 20% or 60% doesn't mean that a portfolio lender is going to pursue that transaction. Another point is there are different levels of approval that a lender can take. So if you have less than 10% down, we have to do a full review. If someone has 10% or 20%, we have to do a limited review. But in all of those reviews, we have to send a condo questionnaire to the association management company. And as Oris talked about, they've added structural questions that they want responded back to us. And in some cases, they'll ask, in the last 5 years, have there been any inspections on the building? Because what they want to find out is, are there any ongoing or new structural integrity questions that might be related to this property that could affect financing? So regarding the condo, I'm going to ask for Kelly's perspective in a little bit, but also on insurance. In many cases, we have first-time home buyers that have debt-to-income ratios that might be 44, 46, 47%, and that insurance piece is critical. One thing that many of us at Alaris have started to do is, the minute a client's looking at a property, even if we're in inspection, we're asking them reach out to an insurance agent, because if we're expecting insurance is going to be $2,500 and it's $3,500, that can absolutely affect their qualifying, and we don't want to find that out 2 weeks before closing, obviously. Kelly, I would ask you, do you have any feedback from the underwriting standpoint on insurance or the condo perspective?
I really don't. I don't know much more I can follow up with after these two experts just presented. I mean, truly, it's the quickest we can get the information, like you mentioned, Brian, the better. I know everything is a quick close, but we have been working with Condo Tech for our approvals, which has helped, but there are some that still are not warrantable. And as you mentioned, we will put those on, consider them for our portfolio. So we typically try to find a way to get things done. Insurance has also been a little bit of an issue. These are topics that are swear words for all of us, I think. But so thank you for having this today and everybody attending. I think it's been great information.
Excellent. Laura and Oris, you can bring your faces back. I've got a few questions. We'll first start with Laura. Are the metal roofs dent resistant?
That's the reason why insurance companies love them. Technically, they don't get damaged by hail. It's cosmetic damage, and cosmetic damage is a specific exclusion of most insurance policies.
You also shared with me that now they're coming out with metal roofs that actually have dents, random dents that are put into them.
Yeah,
Brand new
which
product.
is awesome, because the last thing you want to do is spend 50 grand on a metal roof that's, got smooth surfaces and the snow just slides right off, and then a hailstorm comes through and all of a sudden you've got cottage cheese roof. They don't like that. So the manufacturers have gotten really smart, and they've started to make them look, number one, like architectural shingles, which is a really cool thing, but also they put little pre-dents in them, kind of like if you think of like hammered copper. It's really cool. There's lots of cool products out there.
Laura, how do you know what type of coverage a condo all in versus bare walls, or
Bare walls.
all walls in?
Typically, there's a summary sheet that the insurance agent who sold the master policy to the association, typically that insurance agent sends out an annual letter to homeowners. So if you're representing the seller should have that. A lot of times they lose it though, so be prepared for that. Just call the management company. They know who the insurance agent is, and you can call that agent and say, can I get the summary sheet? Usually the summary sheet will distinguish which type of policy it is. If they don't, or they don't have a summary sheet, and you just have like what's called a certificate of insurance, it actually spells out on the certificate, is it all in, is it bare walls, original specifications with exclusions. It says it right on there. You just kind of need to know what you're talking about.
My recommendation to clients, if they have a condo association that's walls in, so it covers everything on the inside, I'm still absolutely encouraging them to take an HO6 because we're finding deductibles 5,000, 10,000, 20,000, and that HO6 can cover that deductible.
Yeah, and also their personal property and their personal liability. Um, but the big thing is the deductible for sure. Like now I'm seeing $50,000 all over the place. It's crazy.
Let's see. Roof shingles, Laura. We have
Yeah.
an agent that wants to know who that provider is. Should they just come straight to you to find out?
Well, the one that I have in my agency is Foremost Insurance. They're owned by farmers. They're a specialty homeowners company, so they do rental properties, they do vacant properties. Nobody does vacants anymore. They're really good for that. Farmers agents can sell them, and most independent agents have contracts with Foremost. I believe State Farm does, but I don't have access to their underwriting, so I'm not sure. But I mean, my big carriers like Travelers, Safeco, Auto Owners, Liberty Mutual, Hartford, AAA, none of them will take wood roofs right now. It's crazy.
Wow.
Yeah.
Wow. Forrest, we've got a few for you. Does that mean all units are unavailable for lending or only the unit that is suing when there's litigation?
Yeah, well, again, it depends on the litigation. Just because there's litigation on a property doesn't make it ineligible for residential mortgage financing. Again, you could have a slip and fall case, which is easily resolved, or the requirements from the agencies is that you have an attorney letter along with, a letter from the insurer saying that they will, cover this litigation. So only certain litigation is impactful. Of course, when you have construction defect litigation or something of that magnitude where a condo association is suing the original developer, or if you have litigation that's really going to impact the association financially, that is absolutely an issue, and that will make the entire property ineligible. Means every single unit in that property is ineligible for residential mortgage financing through Fannie Mae and Freddie Mac.
Grant Park downtown is a great example of they had some structural water intrusion issues, and we found out about a month ago that an Alaris loan officer had gone through the condo project approval and got that updated, and now they can accept mortgage loans in there, so that's a great thing. For any panelist, what's the outlook on purchasing townhomes and condos? Should we tell buyers to expect higher monthly costs? Are we worried about possibly more foreclosures and or lower home prices as a result of the higher insurance costs? Forrest, are you an expert on that?
I don't know if I'm an expert, but I will say this. I think that what's changed in the industry and what we're seeing in the industry as a result of increased cost for insurance and just inflationary costs, going through the roof, the cost to repair a roof, the cost to repair, any of the common area components in condo property specifically. We're seeing an adjustment in the industry, and we're in this weird adjustment space right now where not only do you have to comply with the residential mortgage guidelines that are out there, but you also have to think about the cost that will make you comply. The answer is this. I think communities have for a very long period of time in some areas have not complied, have not thought about their future, have not thought about reserves, have not thought about putting aside this capital in order to make sure that their components be repaired and replaced appropriately, and they have the money to do so. And I think they're paying the price for it right now. And what you will see is an adjustment or a leveling off of that because data is becoming more available. These properties are becoming non-compliant. They have to get fixed or else unit values plummet, right? So I think that we haven't seen the end of it yet. I think a lot more communities are going to be non-warrantable. But I think eventually there'll be a leveling off. The key is this, especially for the realtors on this call. Do your due diligence. Make sure your buyers do their due diligence, right? Get a pre-approval from the mortgage company. Make sure that your buyer is not only qualified, but that the building is qualified, right? That the building is compliant. as Laura said, call her up, get get a cost for insurance for that prospective purchaser, figure out what it's going to be. So not only do you qualify that borrower appropriately with the right insurance cost in there, but that borrower knows how much their payment's going to be very early on, and maybe it's a great way of kind of leading them to something that they could definitely afford. So it was a long answer, but I think
It's a tough question.
Yeah.
It would seem that management companies should ultimately be responsible for ensuring homeowners association is informed of these restrictions requirements. Forrest, are there any regulations that require them to act in the best interest of the property owners?
Sure. I mean, property managers are required to act in the best interest if they're managing a property. It's often outlined not only within their licensure, but within their specific contracts with these associations. Does that always happen? No. I'll tell you that I do a lot of education for property management groups, large national and local property management regimes and companies. Um, and they're just like everybody else. They're just learning about this right now. It's only been the last 18 months where more than 5,500 condominium properties have been, deemed ineligible for residential mortgage financing. 2 years ago, I think there were 200 properties or 300 properties on the list. So this is relatively new, and property managers are learning alongside of everybody else.
This is from Michael McGee. I've seen legal descriptions that include both lot and block and a CIC number. So what is it? A condo or a townhouse? Forrest.
I'm punting that one. I don't know the answer.
I've had those too. So sometimes in being proactive in transactions, I see lot and block, I see an outline of the property, but then additional research finds that it can be a condo still. At Alaris, we do as much as we can to be proactive up front before an offer is even made, but in some cases, we're just not going to find out or be able to solidify until we get it to Orest and his group to, make a final confirmation. At Alaris, we guarantee you we're going to do everything we can to put you and your client in the best position possible when they're putting an offer in. Orest,
Let me add to that. Let me add to that, because to your point, what we do in those instances and making that determination, sometimes it's a request for the legal documents and the creation documents of the condominium association and or the townhouse, and it's easily determined at that point in time if you look up what the property is legally. If they are essentially governed by a set of bylaws, and looking into those bylaws, it'll give you a good outline of whether or not it's a townhouse or a condominium. But again, that's kind of 3 steps in. So I don't know the answer to the first question, whether or not you get defined through a block and lot, but we usually delve into it in a much deeper manner.
well, we want to
I'll
thank.
just chime in real quick from an
yeah.
insurance perspective. They're all the same. So that's an easy answer for me. It's all HO6.
Well, everyone, we want to thank you for coming out and joining us today. We thank our panelists with their expertise. As always, Alaris wants to bring you value, and our partnership with you is critical. So thank you for trusting in us. If you're not connected with an Alaris loan officer, please shoot me an email, brian@brianparkinson.com. We'd love you to get you connected with a great loan officer. Have a great day, and thanks for joining us.
Thanks, everyone.
Yes.
Thank you.